Morning, ladies and gentlemen, and thank you for joining Boutiques on Wednesdays, where we bring you the investment management experts updating us on world events and the impact thereof on various asset classes. Today, we will have an in-depth look at local and global property, or rather REITs. It has long been advocated that property is a good diversifier in client portfolios, offering a very compelling argument, especially if you look at valuations both on local and global property. But the global property side, we are disappointed once again. However, if you look at South African property, it mostly outperformed all asset classes the past 12 months as at the end of June 2025. But what now on SA property? Was the good returns just a short recovery? And what can clients expect going forward? And how should we think about global property, especially given where the world are in a slowing environment? What can clients expect, and how could the enforcement of Trump tariffs impact on these asset classes? Who better to do so than one of the top property fund managers covering local and global property, Kunai from Sesfikile Property Investments. Good morning, Kunai. Great to have you with us this morning. How are you doing?
I'm well, Eugene. How are you?
Fantastic. Thank you so much again for joining us. I'm sure a lot of clients having a lot of questions on property. As I said in the introduction as well, we've seen the past year and a half that a lot of property presenters, including Sesfikile, said you have to use property as a good diversifier. SA property came through very strong for clients, and I think some clients might have a bit of FOMO, maybe missing out on that and wondering should we allocate more to SA property. And then, of course, obviously, of course, what about global property? It's still in the slump, but I'm going to park it there. I'm going to hand it over to you. And Kunal, you can share your presentation if you're ready.
I am ready. Thanks, Eugene. Let me just try share now, and then we can get going. All right, I hope everyone can see that. Eugene, can you see that presentation?
Absolutely perfect. Thanks, Kunal.
Okay, let me get right into it. Well, morning, everyone. My name is Kundai Munzara. I'm a portfolio manager and director at Sesfikile Capital. Today, I'm kind of wearing two hats in that I'm talking about what has happened and what is happening and how we look at the SA listed property sector, and then close off with the global property sector. Kind of wearing two hats, as it were, on this chilly Wednesday morning. And today, I guess it's probably very interesting for markets. To some extent, the 9th of July would have been the deadline that President Trump put on the tariffs. And in part of our presentation, what I just want to talk about is how we've been, positioning the portfolios, particularly on the global side, to navigate against that. But the theme for today is twofold, in that what we're seeing is that distribution growth is starting to really inflect up locally in an SA context. And offshore, you've got many tools, many different sectors and stocks to choose from to navigate this global uncertainty, largely driven by the tariffs and a little bit of geopolitics as well. But to kick off on the SA side, and I think, Eugene, you pointed it out quite well to say that listed property, South African listed property has had a strong 24 months or certainly 18 months if you look at, or 24 months really, if you look at June 1 year back and 2 years back, but also if you look at the calendar years 2024 and 2023. So 2023, the property sector did about 10.7% in total returns, and it was the best performing asset class by a more narrow margin. But 2024 was much wider, where the sector delivered a massive almost 30%, outperforming all major asset classes over that year. And this year has been fairly strong as well. And many of our clients, including some of the people on this call, may be scratching their heads and also wondering, was it, a recovery that is done and is missed, and is there kind of no legs left in the property sector? We think different. And if you look at what we have here on the chart on the left-hand side, what it shows is that the sector has definitely recovered to some extent, but certainly not to the levels it was back in about the beginning of 2018, where we had the major drawdowns driven by the hedge fund allegations, and then the massive drawdown that we saw in 2020 driven by COVID. We are recovering, but we're not all the way back up. Not to say that we're going right back there, but I do think that the sector is poised for a decent recovery going forward. Now, if I go into the major sectors of the listed property sector, just a bit of a recap. The sector is now at about a 600 billion market cap, still quite small in that it's between 2 and 3% of the JSE. But if you look a little bit deeper at the exposure that you get in listed property, what you do get is 63% exposure in the retail sector, about 15% each in either offices or the industrial sector. And then you've got a balance of self-storage, residential, and healthcare. And I guess what would kind of loosely term as other. That's kind of a catch-all for other sectors that we find. But really, at the end of the day, when you're talking SA listed property sector, retail can never be ignored. And on a regional level, what we do find is that, almost half of the assets or the see-through exposure is actually outside SA. Central and Eastern Europe does dominate at about 27%. That's Romania and Poland in the main. You've got a little bit in Australia. Western Europe, particularly Spain, starting to gain in prominence, and very recently Portugal, and then you also have a little bit in UK. So it's obviously a very globally diverse sector with about 50% exposure in SA. Now, delving into the biggest sector where you really get a lot of the exposure, a lot of what we're showing here is actually encouraging news or good news, in that what we see on the top left-hand side is that the retail vacancies in the listed property sector are low and continue to compress at about 3% across the board. Generally speaking, once 97% of your assets are occupied, you would probably consider that largely full, because there's always a small percentage of what we call frictional vacancy. And that's where tenants are moving from one part of the shopping center to the other, or leases are expiring and there's a little bit of a downtime for another tenant to come in. Largely, it means that many shopping centers in South Africa are full. What is encouraging for us as we look forward is that there isn't that much new space being created. And I think many of us will probably doubt this because, we do see a lot of shopping centers around the major cities and even in some of the rural locations. But relative to previous periods of, let's say, 2017, 2008, as a percentage of the total space that's there, there isn't that much new space being created. So supply is not that much of an issue. And where we start to get even more encouraged is the ratio or the bars on the bottom, on the bottom, sorry, on the bottom left-hand side, that is the rent to sales ratio. And what that talks about is looking at affordability of rental from the tenant's perspective. Quite simply, what that ratio is asking is how much is in rent am I paying as a tenant relative to my sales. As that ratio starts to go down, that is encouraging, because for the tenant, it's becoming more affordable to operate out of that space. And ultimately, what that results in is better negotiation power in the hands of the landlord. And what we're starting to see on the bottom right-hand side is rental reversion starting to turn positive, where in 2020 they were negative to the extent of about 10%. Now we expect that number to go to about 2 to 4%. The most recent number was about 1.8. So it's an encouraging sign, despite everything that's been thrown at the consumer. Higher interest rates, yes, they are coming down now, but over the last couple of years, the consumer has had quite a few things thrown at them. The retail sector remains quite strong. Now, if we hand over to the office sector, or move over to the office sector, I think many would have seen this headline either by the Financial Mail and other publications that, and it was generally widely considered that the office sector, was coming to the end, and some would put comments as far as the death of the office. And that was really driven by what was happening since 2020 when the COVID lockdowns happened. What we did see is that many people obviously had to work from home. And as markets and economy started to open up in 2021, 2022, many people kind of didn't return to the office in the main. And what that resulted in, if you look at the some of the charts on this slide, is that the vacancies started to go up, really because the starting point was an oversupply position. But since about 2022, what we've seen is a continuous drop in vacancy rates in the office sector. On an overall basis, the office sector is at a vacancy rate of about 12 to 13%. But what we're quite encouraged by is what we're seeing in the prime grade space, which is P grade space. This is the newest space in the office market, and that's at about 6.8%. Broadly speaking, what you find is that when vacancies reach about 7%, you do find that the bargaining power starts to shift to the landlord. Again, you start to see rental growth going. Where we still have concerns overall is in the B and C grade space, where we think vacancies are still quite high. And in a kind of small extent, we've seen some conversions happen, but it's really quite a small matter. And negative reversions are still, par for the course. When we look forward, and this may be discouraging for some of the people out there that relocated when they were allowed to work from home, actually moved cities on the basis that they'll never come back to the office. What we do see here is that relative to 2022, so if we look back in 2022, only about 2% of people were in the office working on a full-time basis. And now that has shifted to about 38% of people working fully in the office. And about 70% of people in 2022 were working in a hybrid format, effectively coming to the office some of the time and having some level of flexibility. And that number has moved to about 57%. So it's gone down in favor of people fully in the office. So what you find is that there are just more people in the office. As a result of that, tenants are starting to make firmer decisions about adding more space or taking back space that they had sublet in the previous cycle. So we do see the beginnings of what we think is a recovery in the office space going forward. Now, moving over to the industrial sector, the industrial sector has been quite strong over the last, I would say, 5 to 10 years, but a lot of the strength came from the two main drivers. One is supply chain modernization. So what a lot of the retailers have been doing over the last many years is to try and modernize their supply chain so that they can move goods and store goods more efficiently, so that they just improve their margins. Another driver has been the growth in e-commerce, and 2020 obviously was, we could say, a watershed period in the shift in the amount of e-commerce penetration in many markets, including South Africa. And as a result of that, we've continued to see low vacancies in the industrial space. However, despite those low vacancies, what we found was that industrial reversions were continuously negative. And this was a bit of a concern for us. And after a little bit more research, what we found is that it took about 10 to 12 months to develop an industrial warehouse. So supply responded much quicker than in other sectors, such as the office sector or the industrial or retail sector, where it takes much longer to develop or to add new supply. But what we found now, due in the main to escalating building costs, is that we've seen that the replacement rental, should you develop a new warehouse, is now much higher than the in-force rentals that we have in a lot of the portfolios. So the net result is that we've started to see the industrial market see market rents start to grow. And in many cases, they've started to grow in excess of inflation. On a national level, Q4 2024 numbers were about 6.7%, which is well in excess of inflation. If you look as well at the company level experience, growth points, industrial portfolios, like-on-like NOI, net operating income growth has been about 3.5%, with SA Corporate's industrial portfolio growing at about 7.2%. So all very encouraging signs from a going forward basis. Now, If we move on to another factor which we think has been an absolute tailwind for the listed property sector is the matter around solar. So over the last couple of years, and really prompted by the peak blackouts or load shedding levels that we saw in 2023, in the middle of 2023, a lot of the listed property companies invested heavily in solar backups. And what that has meant is that a lot of the shopping centers, or a lot of the sector, about 14% on an average basis, but in some cases as high as 30% for some stocks of their power is produced by solar. Now, the tailwind really comes from the fact that a lot of these investments have yields of about 15%. Versus the cost of capital, the cost of funding at about 9.4%. So every investment that these companies are making in solar is accretive to the extent of about 6%, which is actually much more lucrative than buying the physical real estate in many cases. So we think that this continues to be a tailwind, and we are seeing the benefits really happen on the cost side, where a lot of the net operating income is starting to accelerate because you've got strong top line rental growth just driven by good tenant demand. But on the cost side, you're getting many benefits from the solar side. So we think that all of these factors really start to, add to the case for listed property in the near term. Now, turning to balance sheets, we're also quite encouraged by a couple of factors, in that generally, the listed property sector has done a great job over the last 4 or 5 years to help themselves to repair their own balance sheets. So loan to value ratios, or the debt to asset ratio, was at about 43% in 2020. And since 2022, as interest rates started to go up quite considerably, we have seen some asset value write-downs. But through this whole period, what we saw is that the listed property companies disposed of many properties, many of their non-core properties. And the number that we have to date is about 49 billion that was sold over the last 4 years at about 0.3% premium to book value. And what that has resulted in is a much healthier loan to value ratio across the sector of about 37%. In addition to that, what is also encouraging for us is that the companies are back on the front foot with respect to the ability to raise capital, to shore up their balance sheets, and in addition to that, to acquire assets accretively. So there's been a combination of better balance sheets, good demand from the banks to lend to them, so the bank margins have started to come down. The companies are back to capital raising again, and the numbers work that a lot of the acquisitions, developments are actually accretive to earnings, all contributing to the growth story. So what we're really talking about when we talk about the South African property sector is a story about, growth inflecting up across the board. And what this shows, which is really the crux of what we wanted to communicate today, is that a lot of the rally that we saw in 2023 and 2024 was really a rating-driven rally. Simply put, the sector was trading very cheap, and I think it wasn't deserved to have that sort of rating based on the forward-looking estimates and where the valuation story was. So a lot of that has happened, but as we go forward, this next growth cycle from the sector is really driven by distribution growth that is inflecting up. So if I put some examples to this, what we see, what the charts show or the bars show, is that the previous distribution growth guidance in the gold bars, and then the updated growth based on their guidance or analyst estimates is in the green. And what that shows in many of these instances is that there's quite a significant delta or change to the positive, where companies initially were targeting, in the case of a tech, 18% growth in their earnings, and now they're targeting something like 26%. Resilient recently put out a trading update where initially the market was expecting about 5.5 to 6% growth, and now they're guiding something in the region of 8%, similar to Growthpoint, which is really a story of inflecting up, where they initially expected their growth to be negative to the tune of about 3.5%, and now that's going up positive now to about 2%. So we think that this is an encouraging, healthy sign for the earnings power of listed property going forward. And what we're really encouraged by is the fact that a lot of these tailwinds are actually recurring tailwinds. They're not once-off items, and they're things that we can comfortably put a multiple to, which starts to really encourage us about the South African listed property sector. So when we look at the valuation story, the valuation argument for listed property is still quite sound, especially when you look at it relative to bonds. We think on a relative to bond basis, the sector is trading fair. But what I think is not yet fully appreciated is the fact that the growth is starting to inflect up or accelerate even faster. So we think the yields on the property sector relative to bonds are justified, and to some extent could even trade at a deeper premium to the sector, to the bond market. Now, if we look at the price to net asset value, the NAV, the sector is still trading, despite the fact that we've had value write-downs, and we're starting to see values go up around 2 to 4% across the board. It's still trading at about a 27 to 23% discount to net asset value, despite the fact that 49 billion of assets was sold out of the sector at about a 30 basis points or 0.3% premium, is still trading at a discount. So this gives us quite a level of comfort when we're thinking about what the sector's prospects could look like from a valuation perspective. Now, to close off on the local sector, there are a couple of issues that we all have to grapple with in South Africa. I think, today, or this week, we've been told about the potential tariffs of 30%. They could go up to 40%. We're really not sure. There is a little bit of risk of instability on the GNU, and I think this is well documented, well known. But on the tailwind side, what we do like is that electricity supply has improved significantly, much more stable on the grid and much more predictable for companies to plan and save. Property fundamentals are improving, and I think that's across the board, even in the office sector. The solar rollout has been great for margins and also for returns. Interest rates have a little bit further to go, and that adds to the earnings side and also the stability of the balance sheets. And putting those factors together, the sector currently pays a dividend yield or income return of about 8.1. Distribution growth is starting to inflect up between about 5.5% and 6%, and we think there's upside risk to this number going forward. Putting those factors together, we think about 15% per annum in the listed property sector SA context should be achievable over the medium term. Now, changing my hat a little bit and going to the global property market, when we talk about the global listed property environment, what we're really talking about is the global developed property market, really dominated by the US at about 70% exposure. You've got Europe and UK at about 14% combined. Japan, quite a significant market at about 7%. And then you've got the balance of Hong Kong, Canada, Australia, and Singapore at about 2 to 3% each. But you've got about 8 different regions to choose from. But where it gets a lot more exciting is you've got about 16 different sectors that you can use as part of your toolbox to build your portfolio. If you recall, a couple of slides ago, we spoke about the South African listed property sector, which is really dominated by 3 sectors of retail, office, and industrial. Here, industrial, multifamily, which is apartments, healthcare, data centers. You've got diversified. You've got the self-storage sector. Many different sectors that you can choose from when building your portfolio. And in many ways, the global market 20 years ago was dominated by 3 or only 4 sectors in 2000, which were about 87% of the market. Going forward today, those large, traditional sectors are only about 39% of the total exposure. So our approach is what we call the concentrated thematic approach. And what we do is we spend a lot of time debating, discussing themes that are happening globally. And ultimately, what our objective is to test those themes against real estate fundamentals, to pick the stocks and the sectors that we think will be beneficiaries of those themes and vice versa. The market, the overall global REIT market, is about 1.7 trillion by size, with about 350 companies to choose from. So it's a lot of choice that you can work with. And in that market, what we have found is that there's a wide bifurcation between different sectors and different regions in terms of the total returns they deliver. So if you just look at some of this research by Cohen and Steers, over the last 4 years, there's been a major difference from one year to the next between the best and the worst performing sectors and the best and the worst performing regions. And ultimately, what we've found is that the opportunity for alpha in the REIT space, the global REIT space, is a little bit better. And that's because there's a lot less coverage per stock if you look at relative to equities. And what we found is because of the ability to move across these different sectors and regions, a lot of the REIT generalists have underperformed the REIT specialists by a margin of about 80 basis points over 10 years and about 2.2% over the last 12 months. So generally, the specialists have done better in this space because of the wide array of choice, plus the fact that there isn't as much coverage as you find in the equity space. Now, getting into the key themes, I think many of us do remember this picture or have this image from a couple of months ago when the reciprocal tariffs were announced. And today, the 9th of July, would have been the deadline for a lot of the tariffs that were announced on this day. President Trump has, I think, extended those the 1st of August. And I think it's a little bit gray, and the market is kind of looking through it on what's really going to happen and what's going to happen to which countries in particular. So it's a tricky time to navigate. So what we thought from our perspective is the global space actually gives you a ton of choice, a ton of specialization, where you can navigate different sectors that in some cases are not as affected by tariffs as, something, like the consumer space, which is about, actual goods being moved from one side of the globe to the other, it's particularly China to the US, and that's probably where you carry the most risk. And in that case, the sectors that we think will do well relative to other sectors in this space is what we call the healthcare space, and we call it the necessity-based real estate, in that whether it's a bull market, whether it's a bear market, and whether there's a tariff, when people consume healthcare real estate, be it hospitals, clinics, senior housing facilities, most of the time they're doing it out of necessity as opposed to out of choice or based on any particular tariff policy at the time. And our story here is really a story of demographics, where we find that the baby boomer population, which is the second biggest population in the US, is growing at about 3 to 4% per annum, that population cohort. And that is as compared to the overall US population that's growing at about 0.5% per annum. What we like about that is that is an indication of forward-looking demand for healthcare-related real estate. And what is encouraging for us is that the supply side is looking even better from a real estate investing perspective. A lot of what's happened is as a result of high regulation, the higher interest rate environment, we've seen a complete collapse in new supply of senior housing real estate. And this is what encourages us about this sector. However, what is also encouraging when you look at this sector is that we're seeing a massive recovery in the occupancy rates in this sector. In 2020, what happened is the occupancies fell quite dramatically as many of these facilities were closed to new entrants due to COVID lockdowns or COVID restrictions. And unfortunately, a large part of the population cohort, the older population cohort, suffered a lot more from COVID deaths. We saw these facilities receive occupancies or vacancies go up to about 25%, but now we've continued to see an improvement on the occupancy rate, and we think that they've got a little bit of way to go from the current levels of about 92%, and we think they could get to about 96%. So the earnings growth story is intact. Moving on to another sector that we think will still show strong growth, irrespective of the tariff policy, is AI and big data, particularly the data center sector. And if we go, maybe 20 to 25 years back, the internet was I guess, a lot less sophisticated, where we had web, a little bit of social media and SaaS platforms. 2020s is really when the data center industry really started to gain some momentum due to the advent of cloud computing. As more companies started to store their data in the cloud, effectively this data was stored in data centers. The pandemic really accelerated streaming and a lot of storage of data, and also some of the social media platforms. And very recently, obviously, we've seen that AI has been the big major issue that has been a key demand driver for data centers. Now, what does that mean? And many will not, forget that DeepSeek moment that we had at the end of January, when DeepSeek was announced, and we saw a massive drawdown in a lot of the companies, particularly in this data space. But what is encouraging for us is a lot of the hyperscalers like Amazon, AWS, Microsoft, Meta continue to make major capex investments between 62 billion and 100 billion each in this data space. And what is encouraging for us is that, irrespective of the tariff, it's becoming more difficult to develop more data centers, and there's a massive demand push coming from a lot of the hyperscalers. So we think that the earnings growth trajectory for the AI and big data sector continues to grow, even if there's a little bit more geopolitical environment becomes unstable, even if we do see more tariffs going forward. Now, to close off, when I talk about the valuation story, the global property space from a fundamental perspective is in decent shape, and that vacancies are about 7%. What is more encouraging for us is that we do see the construction starts really collapse from the peaks in 2022. And we think going forward, more power will shift to the landlords, meaning that rentals can grow faster. Balance sheets are in good shape at a loan-to-value ratio of about 32%. And what's encouraging for us is that there's only a small amount of debt, about 8% per annum, that expires in each of the next 2 years. So refinancing risk is not really a big issue. When you look at the valuation of the sector is trading at about a 14.4 times funds from operation, or FFO multiple. Put another way, the sector is trading at about a 7-ish% yield from a distributable income perspective, and the dividend yield is about 4%. And what's also encouraging is that the price to NAV for the sector, despite the fact that we've had a massive drawdown in valuations of about 18% over the last 2 years, and valuations are starting to go up again, the sector is currently trading at about a 16% discount to net asset value. So also showing value from a multiple perspective, and also from a price to net asset value perspective. Putting those factors together, the sector is trading at about a 4.4 dividend yield. Bear in mind, this is a dividend yield where the companies are able to actually pay out more, because the payout ratios are close to 70%. And growth in earnings, similar to South Africa, is close to 6% over the next couple of years. And we think there's upside risk to this number from year 2 and year 3 onwards. Putting those factors together, we think the sector is poised to deliver a decent 10 to 12% total return per annum in USD, which we think presents good value, because this is close or a little bit higher than what the long-term return trajectory has been from global property. Now, to close off, I'm Kundai from Sesfikile Capital. We started back in 2010, so about 15 years old, with a specialist approach to the listed property sector, with about 18 billion in assets under management and 16 years average experience in the investment team, which I think makes us one of the most experienced teams in the sector. Thank you very much. Happy to take questions.
Good night. Thank you very much for once again for a very clear-cut presentation, as we always get from Sesfikile, putting your money on the spot and telling clients what they can expect. But let's stick to global property. I'm going to get back to local properties now. But just on global property, and specifically looking at the AI sector, Maybe just for the audience of my understanding, how do you position for that specifically and that growth opportunity in the Sesfikile Global Property Fund?
Thanks, Eugene. So we do it mainly through two companies or two stocks. There are a lot more that you can choose from, but where we've put a little bit of our more conviction is one. The main one is a Singapore data center company called Keppel DC REIT. And Singapore is particularly interesting because the restrictions on developing new data centers are, I guess the barriers are higher than any other market. It just makes whoever has those data centers much more valuable. So they're seeing rentals grow in the region of 40%, new rentals. And if you're talking AI, the other stock is one in the US named Digital Realty, with a larger focus on hyperscalers. So what you find is that if you want to really focus the portfolio or that part of the portfolio in the AI space, you have to position it in a data center company that has a lot of hyperscalers like AWS, Meta, Oracle. And those are some examples of where, some of our overweights when we think of data centers are.
Very interesting indeed. And what about regions like China? I mean, would you consider regions like that, especially with the fast development on AI that side as well?
No. So in this particular strategy, we've been very deliberate to make sure that this fund is exposed to developed markets real estate. And China, is not yet there from a developed markets perspective. So maybe soon, maybe another time, but at this point, we don't look at any emerging markets like China.
And again, staying with global property, and I mean, we've seen very compelling arguments on valuations and recovery in the global property sector for the past 18 months. But if I look at global property returns over the past 12 months, even the past 2 years, it's again very disappointing. Why is it different now? Why should we continue to support or look at global property as a part of our global carve-out in client portfolios?
Yeah, good question. I think a lot of maybe the underperformance in global property, if you look at the last 2 years, I think has largely been driven by maybe interest rate uncertainty in the main, as opposed to the fundamentals, because those have generally been good. But this year, global property is up about 5% in dollars. So I don't think it's a terrible showing. Disappointing over 12 months, but over 6 months, I think it's been okay. But as the sector continues to get more, get cheaper relative to equities, the relative argument just starts to make sense, especially if the fundamentals are fine. And what you do find is that the sector, although it has bond and equity-like properties, is a good diversifier, and that over the long term, it's got a beta of about 0.6, 0.65 relative to equities. So if you're looking for a diversifier in your portfolio, you do find that global property does better. Also, when you find that the general microeconomy is slowing down, as I think is the case, you tend to find that the more defensive parts of I guess the market opportunity, like global property, are probably where you should start to kind of allocate your capital. So we think valuation argument is strong, fundamentals are good diversifier in terms of the long-term behavior of the sector, and very cheap relative to equities. And I think it will be more defensive, the earnings profile will be more defensive in a slower economic environment, which I think will be the case over the next 2 or 3 years.
The valuation argument obviously being a very strong argument and part
Yeah.
of that. But if we look at the SA property sector, and it's one of I think the third or fourth slide you had on almost showing regional exposure if you buy into SA REITs. But if you buy SA REITs or the SA property market, you're already getting a lot of global exposure. Why shouldn't clients just be satisfied with that and just go for SA property because you're getting all that global exposure?
You do get some, that's true, but I think what is quite clear is that a lot of the global exposure you get is Central and Eastern Europe. Good markets,
Yeah.
strong markets. But a lot of that is actually emerging market exposure. So, and also I think if you look at the choice that you do get in the UK, it is some good stocks like Shaftesbury and Hammerson, but you don't get the real, the full spectrum of choice when you look at the UK exposure within the OP. So you do get some global exposure. I definitely agree with that point, but it's different exposure because a lot of it is emerging and some of it is limited choice in some of the markets like Australia and the UK.
Exactly for that reason. Um, the SA property market, I mean, the numbers that you showed there on a lot of aspects are definitely very exciting. And you're 100% right. I mean, some of the returns over the past 2 years was maybe just a re-rating, but the fundamentals on SA property really, really looking good or still looking good.
Yeah.
So one of the numbers that you always refer to is distribution growth. Some of the REITs that you showed, obviously some very strong numbers, but let's look at something like Growth Point. I mean, although positive, rated upwards to 2%, but compared to a lot of the other holdings, definitely a lot lower. But Growth Point is still one of your top holdings in your SA property fund. Why would you continue to hold a company like Growth Point if the distribution growth numbers are maybe not that strong? Maybe just from my understanding.
Yeah, thank you. I think first point is we are benchmark cognizant. So in one aspect, growth point is a big chunk of the benchmark. So we will typically hold a decent holding in growth point. But I think the more important factor is our weight in growth point relative to the benchmark. And I think what you'll find if you've been tracking it and I think you probably have been for many years, is that this year or the last 7 months or so it's the first time we went overweight growth point for many years. And I think it's about
Good.
about 8 years. And what you do find is that distribution growth is one piece of the puzzle when you're looking at the total return prospects of a company. It's also the yield the company offers, and also the strategy that the company has going forward. Now, putting those factors together, what we do find a lot of the time is when things inflect from, let's say, negative to positive, as what's happening in the growth point case of distribution growth, typically that's where the alpha opportunity is. Because things go from a very sort of benign outlook, negative sentiment, to an okay sentiment. And typically that's where the alpha opportunity is because the valuation argument was very compelling. So for us, it was a case of there was just quite too much value in the stock relative to what the sentiment, what the share price was showing. And distribution growth is actually just one element of what we look at when we think about value.
Very interesting indeed, and gives us a bit more insight in terms of how you think of allocating in the fund. In terms of the topics that we sent out, Kunan, you've showed the numbers now as well. Returns that you see for SA property ranging roughly about 15%, global property about 11.
Yeah.
If I were to pump these numbers into an optimization model, the question almost then arises, but then if I look at what clients can potentially expect, I'm almost back to that question to say, but why do I allocate to global property and not just SA property?
Yeah, it's always a difficult one to answer. We get this one all the time. And I guess also one key point is you're looking at about 11 to 12 in USD versus 15 in ZAR.
Yeah.
There is an argument to be made for having a portion of your portfolio be actually really pegged to hard currency returns. And we think that that's what the opportunity is. So that call between local and global is a difficult one. At this point, I think local does offer great value, probably better value than if I was, pushed to a point, I would say local probably does offer better value. But the difficult one is when you think of potential rand weakness, if that's the case, or strength, how does that 12% in dollars look like to you? If you think there's going to be 5 or 6% rand weakness, then off suddenly that 12% in dollars starts to look very attractive because it ends up being about 17 in ZAR. So I think it becomes your call on the rand when you're thinking of how to look at this sector. I think, however, another way to also look at it is look at the behavior of the different sectors. When you're thinking of a diversified portfolio, they don't exactly behave the same between local and global property. So it might be worth it to have a little bit of global and have local from a pure valuation perspective.
And in a global carve-out of a client's portfolio, whether that global carve-out is 10% or 100%, I mean, you just again made a good argument that it is still a good idea to retain global property or some exposure to global property as a very good diversifier in portfolios. And I mean, you've made all the points and arguments in support of that. Kundai, the clock caught up with us. Thank you so much for joining us this morning. It's been absolutely lovely to have you, as always. And I mean, you did say at the very end of your presentation, Sesfikile is definitely one of the most experienced teams when it comes to property, be it SA or global property in the country. And to our audience, you know how it works by now, open door policy. And I know all the members at Sesfikile are always very willing to engage. So if you want to have more discussions on property and how to allocate for clients, please feel free to make contact with us. We'll set up a meeting for you or contact the team at Sesfikile directly. Kunai, again, thank you so much. Great presentation as always. Looking forward to seeing you on the sessions in the very near future again. Thank you.
Thanks for having us. Enjoyed it. Thank you. Thank you, Gene.
Fantastic. To our audience, quick reminder, next week, Wednesday, 16th of July, we've got Anchor Capital and 361 Asset Management, where we will look at local and global equity and to see where we are on that. Very interesting indeed. As always, thank you so much for your continued contribution and joining us, and looking forward to seeing you again next week, Wednesday. Thank you so much.